Good afternoon, everybody. Welcome back to the Opportunistic Trader. It is just after noon on December 6th, and as I said before, it's a commodity-heavy day. We're now speaking with Andy Lebow of Commodity Research Group, and I mean commodity-heavy, meaning that we have a lot of commodity speakers. It is also the markets are trading heavy as well.
Yeah.
Andy's joining us talk about the latest DOE report, and also had a recent trip to Houston, so has some interesting facts from that as well. So, how's it going today, Andy?
It's going pretty good, Michael. How are you doing?
Good, good. We've been talking a lot about energy because it's a hot topic here. We're trading right now crude oil, Jan crude trading at 50.88. RBOB, Jan RBOB's at 139.65, down 3.5%. Take us through, I guess, the start. What was the DOE figures and what was your take on that?
All right, let's start with the numbers. And this is clearly a mixed bag, given that crude drew by 7.3 million barrels, but gasoline built by 1.7, and diesel also built much more than expectations, 3.8. So those two numbers were higher than what the market was looking for, and the market was looking for a modest draw. We were right around unchanged for crude. Total stocks drew by 8.3 million, and that's pretty good. That's a number we definitely wanted to see. The takeaways from this report, first of all, Michael, this is the first week that the U.S. has become a net exporter of crude and products, and we set a record on crude exports of 3.2 million barrels. Hence the big draw in crude, and the draw, not surprisingly, was in the Gulf Coast. So I thought the crude number was good. I would characterize that outright finally bullish. In terms of gasoline, that number was a little shaky and a little shady, actually. If you go in the weeds, there's something called motor. I'm not going to bore your subscribers with inside EIA, but there was one number that didn't quite make sense, and to me, I really thought gasoline outside that number, gasoline would have been unchanged. Demand for gasoline was soft. We're expecting in December, obviously, with pump prices now for the first time below year-ago levels. We think December demand is going to be strong. So this 1 week number really didn't make a lot of sense on gasoline. Diesel. This is important. On distillate, we're seeing big production on distillate, and what's happening, the heat to gas spread last month was 60 cents diesel over. So it's 60 cents over. What are refiners going to try to do? They're going to try to make diesel, and we're seeing it. Gasoline production went down, diesel production went way up. And it takes away some of the bullishness on going forward. We've continued to say, "Oh, diesel's bullish, bullish, bullish," but this is a change, and we saw a big increase in diesel and distillate stocks. Primarily because of the big increase in refiners making distillate, and that's really important. That's something that we were looking for, and it's beginning to happen. And certainly, as we head into the winter, we'll see diesel production even higher.
So, what was the general tone from the people you're speaking with in Houston? Basically on the state of the industry and as they're preparing for 2019.
Oh my goodness. They were, just came back from Houston meeting with refiners and producers mainly. And refiners were certainly as unhappy as the producers, because refining margins have really come in on here in the Northeast and in the Gulf Coast. Gasoline cracks are negative in New York, or they've moved into positive in the last day or two. But when I was down there, they were negative in the Gulf Coast. So obviously they were unhappy. Producers, of course, were miserable because the markets last month it's mid 70s, and now it's trading near 50. So they're certainly not happy. Now they are making money here, at these numbers, but depending on how much you hedged your production when prices were higher, is going to affect what your bottom line is. So I'd say the mood down in Houston was not particularly encouraging. And looking at 2019, producers are always optimistic, Michael. They don't see prices down here. They think prices are going to rally. They always think prices are going to rally. I say there was a little more optimism from the producers than from the refiners.
Interesting. And where's the opportunity that they're seeing right now?
The opportunity in terms of
Is there one specific, any specific catalysts or any specific products, or based on where we are, or whether it be something coming out of OPEC or something coming out of the U.S. administration?
I think this is one thing that came up again in talk after talk is on the on gas. Surprisingly, on gasoline, some of the refiners did see some daylight on gasoline. One thing they mentioned repeatedly was the decrepit state of the Latin American refining industry, particularly Mexico, and of course Venezuela is completely falling apart. So they felt that export opportunities were going to be pretty good coming up in the first quarter, actually pretty good in December. And as a result, they thought gasoline had a pretty good shot here to improve. And in terms of on the production side, they're still thinking, they're still thinking U.S. production is on the rise naturally, along with everybody else. And there was a lot of talk about the infrastructure build out and how in second half, and in particular fourth quarter of next year, that's going to start supporting some of these spreads, between Midland and WTI, and between WTI and between Midland and Houston. That they see the big discounts disappearing. And again, an outright price. Michael, if you talk to a producer, they're always bullish.
Yeah.
No matter what, they're bullish.
So what do you think of the ramifications? There's a lot of different things going on in the Middle East with Saudi Arabia, and then Russia, OPEC. How's everything playing out? Like, for instance, just at the G20, we saw Russia, Putin, and Saudi, the Saudi prince giving a big high five. There's a lot of talk. What's that relationship, and how is that have a possible impact on oil prices?
Well, politics certainly has become an important driver. One other thing of my trip in Houston was, not surprisingly, because it was Texas, was a lot of these managers and traders were saying what a great job Trump had done in driving the price of oil, down to $50. And of course, I mentioned, well, on the flip side, you have to say that he was also, he was one of the things he was responsible for was it increasing to, increasing it to $77 on the whole Iranian sanctions deal. But certainly the Saudi Iranian, the Saudi, Russian, U.S., the big three of in production, it's become key to the markets. And I think looking at Saudi and Russia, certainly the Russians are under a lot of pressure to reduce production. I think ultimately they will modestly. I think they're going to cut 150,000 barrels a day to 200,000 barrels a day. I think the Saudis will, they will also reduce production. They may not say what they're, it may not come out exactly what it's going to be. They're already touting a 500,000 barrel per day cut for December, and I personally think it's going to be another 500,000, in the first quarter, which gets back to what I think is key. What you're hearing are a lot of people talking about, if they cut 1,000,000, if they cut 1.3, if they don't cut 1,000,000, the market's going down, going down. You have to watch the facts on the ground. You have to barrel count. The Saudis, because of the pressure that the Trump administration is putting on them, may not say exactly where the numbers are. That's why you're seeing, you're not seeing cut and dried numbers being presented. But what you have to watch to see if the market is really going to, what the Saudis are doing, what the market sees. You have to start watching. You have to watch the curve. You have to watch the Brent curve. If that's weakened, then it's weakened because the Saudis just put out, in November, they put out an extra 500,000 barrels a day, more than what the market wanted or needed. And that curve is really, you look at the curve, it's softened, it's in contango. If that starts moving in, we're seeing cut, we'll be seeing some cuts. So, you're also going to see cuts from Iran because that's a de facto cut. We granted waivers, but their production is still going to go down over the next 3 months, and then in the second half of the year, we'll see what happens with the waivers. Iranian production could go way down, and I mentioned Venezuela. Venezuela is going down 30,000 barrels a day every month, and probably more than that. So, let's say it's 50,000 barrels a day. Put in 6 months, there's 300,000 barrels a day. So OPEC's going to get de facto cuts from Iran and Venezuela, plus Saudi and maybe UAE and Kuwait. So, they may not say it, but let's watch what happens on the curve and the physical differentials. If they start tightening up, the market, I think, is going to have some upside here, and it could be a significant upside move.
What sort of range do you think we're going to be trading in over the next, let's call it Q1?
That's a tough one.
What are the key factors that would make it?
I think.
What are the 2 or 3 biggest X factors for oil here? I guess that's part of it also.
Well, the big X factor for there are a lot of, Michael, there's a million X factors in oil. That's the thing. We were talking, I think we've been talking over these weeks to come, over the last, since we started, that some of the numbers we were throwing around weren't like, small numbers. They were big numbers, like the Saudis, 500,000 barrels a day. Canada just cut 300,000 barrels a day. That's a big number. Whether or not Nigeria and Libya are going to continue to, provide what they've been providing to the market, there's a big X factor, and to say nothing of the macro picture, which I think is more on sentiment than really real demand, real numbers. Demand is going to be cut. So the demand's going to be cut, let's say 200,000 barrels a day, where production we're throwing numbers, like millions of barrels a day numbers. But nevertheless, it's become a big factor on this, on how the market has been trading.
Gotcha.
But there are a lot, and certainly the political, whatever political and geopolitical factors, and how the market, how the market interprets it. So it's tough to see a range, but I mean, it's certainly.
Well, it's funny. The first 9 months, the first 8 or so, let's call it the first 8 months of the year, we were between $60 and $70. bouncing back and forth, really like more like a $7 range. And it was bouncing back and forth, back and forth. We then broke up to 77, and then we've just crashed down since. And so we've, it was about a year of being range bound, and then a big move
Right, and
up. And
that's a
then
great point. I think personally, I'm more constructive because I do think we're going to see production cuts, and the market is going to move, more into balance. It's still going to be a surplus, but it's not going to be as big of a surplus as it looks right now. So if the market somehow can hold itself together on sentiment, because it's just been as you mentioned, it's just been routed here. I think if we can hold together right under 50, it wouldn't shock me to see WTI rotate back up into, moving into the 60 to 62, $63 range. Wouldn't surprise me at all.
yeah.
But again, the key is, well, let's watch these spreads. I think that's going to be a major indicator. We'll see what I'm not expecting that OPEC's going to have a lot of heavy duty details coming up in the next tomorrow. I think they're trying to duck it.
Yeah. Well,
Duck the details. I think I think it's going to be a pretty,
do you know what time are we
pretty
expecting that
pretty
information?
broad stroke. Well, they say they have an agreement, for a production cut, but they don't have the details, and they have to meet with the Russians. I think Russia, Oman, and maybe Kazakhstan are at that meeting. So that's tomorrow. So we'll certainly know better tomorrow.
Okay. All right. Well, Andy Lebow, Commodity Research Group. I really appreciate it. A lot of great information. Energy's all over the place, so it's good to get as much information as possible. Right now, we're trading 51.05, down 3.5% on the day. We'll keep a close eye on it, but thanks for the info.
Okay, Michael. Thank you very much.